Welcome. Good morning, everyone. I call this hearing to order. I want to thank the witnesses for testifying today. We appreciate your participation. I'll begin with a brief opening statement. But again, welcome and thanks for coming to this Subcommittee on Economic Growth, Tax, and Capital Access, the hearing on pro-growth tax policy. The news today for small business owners is not good. The economic recovery is weak. Small businesses are still struggling. Credit remains tight, and forecasts indicate weak hiring will continue. Washington, which should be making job creation easier, is instead creating more hurdles with the constant threats of higher taxes, excessive regulations, and our unsustainable debt. It seems that no one has a bigger target on his back than the small business owner. As Congress turns its attention to tax reform, the budget deficit, and pro-growth policies, today this subcommittee will focus on the importance of tax reform to small businesses. Specifically, we will examine the need for individual tax reform for pass-through organizations, those that pass through their income and tax liability and pay taxes on their owner's individual tax returns, rather than on a corporate return. According to a recent study by Ernst & Young, about 95% of businesses and over 80% of small businesses are organized as pass-throughs. These companies, such as LLCs, partnerships, S-corps, and sole proprietorships, represent 54% of all business activity and employ 54% of the private sector workforce. Our local small business, not the government, will create the jobs and pull us out of this recession. The Internal Revenue Service's National Taxpayer Advocate has said that the most serious problem facing taxpayers is the complexity of the tax code and the need for reform. Studies have shown that the cost of tax compliance for small business is 67% higher than for larger entities. Pass-throughs are becoming more prevalent. Between 1986 and 2005, their number more than doubled, while the number of C corporations declined. Enacting policies that will keep pass-through taxes low will help small businesses to spur our economy. It is especially important that we consider revamping the tax code in a way that generates jobs and economic growth. Common sense tax and regulatory reform for small businesses will help us do just that. I recently introduced legislation, H.R. 2945, to index the capital gains tax to inflation. Americans should not have to pay capital gains tax on an asset purchased 20 years ago and sold today, but increased in value only due to inflation. Making this simple change would allow small business owners to create jobs and grow the economy. Today, we will hear from an economist and small business owners about why individual tax reform for these pass-through entities, and not just corporate tax reform, must be a fundamental part of tax reform. Finally, I must say a word about President Obama's jobs plan. In August 2009, the President said the last thing you want to do is to raise taxes in the middle of a recession. But yet, that is what he has proposed. Small business owners know that you can't raise taxes and expect employers to create jobs, especially in a recession. But let's listen to our nation's best job creators and consider policies that will truly jumpstart hiring and lead to long-term economic growth. Again, thank you to our witnesses for participating today. I look forward to hearing input on how we can reform the tax code so our small businesses are able to expand, create jobs, and help our economy grow. I now yield happily to our ranking member Schrader for his opening statement.
Thank you very much, Mr. Chairman, and thank you all for being here today. Some of you have come quite a long ways. I appreciate it. I agree with the Chair. Entrepreneurs today face many, many challenges when they're starting a business. I myself am a veterinarian, 35 years, small business, private enterprise, and a lot, just labor, access to capital, just myriad of different problems, marketing, the whole 9 yards. But one of the most important decisions you all make at any point in time is how you organize yourself regarding your tax structure. How do you want to operate as a business? Today we're going to listen to the experts in the field, if you will, by boots on the ground, about how to what is the best way to operate non-corporate business entities, which most small businesses fall under. A lot of the discussion we've had to date has been about corporate tax reform, which I strongly support, but corporate tax reform in and of itself would leave most small businesses behind. And a lot of us have operated as sole proprietor. I've been a sole proprietor, I've been a partnership, and I've been an LLC. And a lot of the discussions that I'm hearing now wouldn't really help me or you or most Americans out there that are the real job creators at the small business level. So I really appreciate the Chair having this hearing on pass-through entities so we can raise America's consciousness about what really goes on. And I've had many tax statements at the end of the year that showed I was making $200,000 to $300,000, and all I know is I was taking $60,000 home in cash at the end of the day. And a lot of my stuff was going back into the business, and the statement didn't mirror what was actually going on. So I really am looking forward to your comments about what really is going on here. Majority of small businesses use the pass-through structure. It offers the best opportunity for reinvesting savings back in the business and hiring employees. That's how you hire people. You make that investment. Small business non-corporate entities actually employ over 50% of the total workforce and report over a third of the business receipts that are out there. So we're an important force, I think, in America's economic recovery and economic development at the end of the day. So at the end of we have to really look at these unique challenges. I'm very concerned on the super committee that there's been a lot of talk about tax reform. Some of my colleagues on the other side of the aisle have embraced the corporate without embracing the actual pass-through entities. Comprehensive tax reform is the way, I think, to bridge the differences between Democrats and Republicans. And so I'm real pleased that my chair has held this hearing today, because this is an area where we can actually have agreement. And frankly, by having this hearing and listening to you, we can push the supercommittee to do the right thing and consider comprehensive tax reform that could lower all our rates, get rid of all these tax deductions, many of which don't benefit us compared to some of our bigger corporate entities, and actually get more money on the table at the end of the day to buy down our debt. That's, I think, the confidence that America has in not just Congress, but our corporate and non-corporate business community to actually be competitive in the global environment hinges on, I think, doing comprehensive tax reform. People are looking for guidance. People are looking for someone to step up to the plate and make the big decisions that make us think that, geez, we actually have an opportunity to compete in this global economy. We can kick China and India's butt instead of the opposite happening at this point in time. And a lot of American small businesses are the ones that are going to be doing that. So with that, I want to thank you all for being here, and I yield back, Mr. Chair.
Thank you, Ranking Member Schrader. This is so nice. We probably could have written each other's opening statements. If subcommittee members have an opening statement prepared, I ask that it be submitted for the record to our witnesses. You'll each have 5 minutes to deliver your testimony. The light will start out as green. When you have 1 minute remaining, the light will turn yellow. Finally, it will turn red at the end of your 5 minutes. And depending on what I think about your testimony, we'll just kidding. Our first witness is Robert Carroll. Mr. Carroll is a principal with Ernst & Young, LLP's Qualitative Economics and Statistics Group. He's an advisor to public and private tax clients on federal tax policy, including revenue and economic effects. He received his B.S. from the State University of New York at Albany and his Ph.D. in economics from Syracuse University. Welcome, Mr. Carroll. You have 5 minutes to present your testimony.
Well, thank you very much, Chairman Walsh, Ranking Member Schrader, distinguished members of the subcommittee. I thank you for the opportunity to testify today regarding the taxation of flow-through businesses and tax reform. I've had the opportunity to consider the taxation of flow-through businesses from a number of different perspectives, inside and outside of government, in the context of broad reform of the code and more narrow reform of the business tax system. Earlier this year, I analyzed the economic footprint of the flow-through sector on behalf of the S Corporation Association, and have been working with various private sector clients to evaluate and understand various aspects of tax reform. Today, I would like to share my perspectives and provide some results from the study on the flow-through sector we prepared earlier this year. Flow-through businesses, S corporations, partnerships, limited liability companies, and sole proprietorships play an important role in the U.S. economy. The vast majority of businesses in the United States have chosen to organize as flow-through businesses. Today, flow-through businesses comprise more than 90% of all business entities, employ 54% of the private sector workforce, and report 36% of all business receipts. Individual owners of flow-through businesses report 54% of all business net income. These individual owners also pay 44% of business taxes when filing their individual tax returns. The flow-through business form provides firms with flexibility in how they organize and structure operations. Businesses can choose between several different organizational forms, which may better match their management needs and capital requirements. With the increasing prominence of flow-through businesses, it is important to carefully consider how the flow-through form fits into the U.S. tax system and how any particular tax reform might affect this sector. Flow-through businesses are subject to a single level of tax on the income earned and allocated to their owners. Thus, it is the tax rates faced by individual owners of flow-through businesses that affect decision-making and the economic health of these businesses. In contrast, the income of C corporations is subject to two levels of tax. First, when income is earned at the corporate level, and again, when the income is paid out to shareholders in the form of dividends or retained and later realized by shareholders as capital gains, hence the phrase, the double tax on corporate profits. The double tax affects a number of important economic decisions. First, by increasing the cost of capital, it discourages investment and thus economic growth and job creation. Second, it leads to a bias in firms' financing decisions between the use of debt and equity. Third, it distorts the allocation of capital within the economy. The flow-through form provides an important benefit to the economy by reducing these economically harmful effects of the double tax. There is a growing consensus for the need to lower the corporate income tax rate. The United States has the second highest statutory corporate income tax rate, second only to Japan. The U.S. corporate income tax rate is also high relative to several other measures. In today's global economy, the high U.S. corporate tax rate combined with other features of the U.S. corporate income tax make it more difficult for the U.S. to attract investment and also may be adversely affecting workers' wages. With the substantial evidence that the U.S. corporate tax rate and tax system is out of step internationally, corporate tax reform is an important component of an overall approach to improving the current tax system. But the focus on corporate tax reform has also drawn attention to how flow-through businesses might be affected by such a reform. As with any such endeavor, it is important to keep in mind the potential for undesirable side effects. Corporate reform that eliminates business tax expenditures would have the unintended impact of raising the taxes of businesses organized using the flow-through form without offering the benefit of the lower corporate tax rate. Flow-through businesses would lose the benefit of widely used and long-standing provisions, such as accelerated depreciation, the production activities or manufacturing deduction, and the charitable giving deduction. In total, flow-through businesses use about 23% of the roughly $120 billion in annual business tax expenditures. Flow-through businesses are a large part of the U.S. business sector and important contributors to the economic vitality of the United States. As tax reform progresses, it is important to understand and consider all of these issues with an eye towards bringing about the tax reform that is most conducive to increased growth and job creation. The path towards tax reform will need to take into account many features of our tax system and strike a balance between a number of sometimes conflicting and competing objectives. The subcommittee should be commended for holding this hearing to better understand the role that the flow-through sector plays in the U.S. economy. Thank you, and I would be pleased to address any questions the subcommittee may have.
Thank you, Mr. Carroll. I now yield to Ranking Member Schrader for the purpose of introducing our next witness.
Well, thank you, Mr. Chairman. It's my pleasure to introduce Gary Morawski, President of Flame Furnace in Warren, Michigan. Come a long ways. His company is founded in 1949. Still in business. That's a great thing. Currently has 70 employees, hopefully more in the near future. And Flame Furnace is one of the leading HVAC residential services in the Detroit metro area. So welcome to our committee.
Thank you very much. Thank you. And thank you, Chairman Walsh, and again, Ranking Member Schrader. I'll flip through my comments. I appreciate the opportunity to testify before you here this morning. Again, my name is Gary Morawski, and I'm the president of Flame Heating, Cooling, Plumbing, and Electrical in Warren, Michigan. We supply services in heating, cooling, plumbing, and indoor air quality equipment throughout southeastern Michigan. Like a lot of small businesses in the HVACR industry, Flame is a family-owned company started in 1949 by my father, Bob Murawski, from a humble beginning. We've been blessed and grown steadily, and today we employ, it's actually about 75 now, we screwed up on what we gave you, workers. We have a fleet of more than 60 vehicles and have installed over 75,000 comfort systems over the last 60 years. I'm a proud member of the Air Conditioning Contractors of America, of where I'm the chairman of the Government Relations Committee. And the ACCA's member companies epitomize the spirit and entrepreneurship of America's small businesses. Nearly 3/4 of ACCA member companies have fewer than 25 employees, and 92% have fewer than 100 employees. Most start out with technical skills, a truck, and the American dream is they're going to create their own business. It is my honor and privilege to give voice to the small business contractors of the heating, ventilating, air conditioning, refrigeration industry on the ongoing and much-needed debate about tax reform. The contribution of small businesses to our economy is often overlooked, but companies like mine employ 70% of the American workforce and are the chief source of new jobs in an economic recovery. I wholeheartedly agree that tax reform must address the individual rates because of their impact on small businesses. Not everyone understands that sole proprietors, partners, and S-corps shareholders pay taxes on business income through individual tax rates. Flame Furnace is organized as an S-corp, as are most of the small businesses in the specialty construction trades, in part because it protects the owners and shareholders from business liabilities and debts. And on the debt part, 95% of all small business owners must also personally guarantee all bank debt, vehicle leases, office equipment, etc. And it also facilitates, as a sub-S, an easy transfer of ownership through stock, through family members, or whomever you'd like to pass it on. Changes to the individual tax rates have a direct impact on pass-through entities, so Congress should be very careful before enacting any tax reform proposals that tinker with the individual tax rates. In 2009, only 7% of federal tax revenue came from the income taxes paid directly by C-corps, what most people assume a corporation to be. Individual income tax revenue, including that from all the pass-through businesses, was 44% of the federal tax revenue in 2009. Unfortunately, it's impossible to say exactly how much came from income tax on the pass-through companies. As you contemplate changes to individual rates in the corporate and international tax codes, I want to take this opportunity to point out that America's small businesses are looking for a simple, rational, permanent tax code that will encourage prosperity, foster job creation. The tax code is a powerful tool that can affect individual corporate behaviors in a way that advance beneficial public policies, like allowing homeowners to take a deduction on their mortgage interest, permitting small businesses such as my company to use enhanced Section 179 expensing limits and bonus depreciation. These incentives work, and my company and thousands of ACCA companies have used them to buy new trucks, office equipment, other investments. An example is the homeowner's 25C residential energy efficiency tax credit for installing qualified high-efficiency furnaces, boilers, air conditioners, etc. The 25C tax credits are easy to take advantage of, and they do not favor the wealthy according to IRS statistics. Fully, 93% of tax credit claims under 25C and 25D for solar, geo, wind, and photovoltaic properties were made by taxpayers who have an adjusted gross income of no more than $200,000, which is indicative of a middle-class tax. The 25C tax credits highlight how a simple tax incentive can help individuals and small businesses create an economic benefit. Americans spent more than $25 billion on energy improvements to their homes that qualified for the tax credits. Now consider the National Association of Home Builders that estimates every $100,000 in remodeling expenditures generates 1.11 new jobs. Congress needs to extend the 25C tax credits beyond their expiration at the end of this year, restore the tax value to $1,500 is my association's. My personal opinion is if we want to drive individual behavior, save energy, create economic activity, we ought to raise the credit to $5,000, and you'll see more than a payback on that. Another important change to the tax code would be to bring the depreciation schedules for HVACR equipment and other building components more in line with reality. According to the tax code, commercial HVACR equipment must be depreciated over 39 years. And if any of you own a building, you know that the air conditioner doesn't last 39 years. This would include doctor's offices, homes, small businesses, car dealerships. That type of building would this would apply to. Let me close by saying the small business community needs certainty. We've all applauded the repeal of the Form 1099 filing provision in April. We're hopeful that the Senate can pass a repeal the 3% withholding tax on government contracts, but the effort to pass these two small business priorities highlights the piecemeal and short-term approach Congress has taken with regard to the tax code. Last year extended more than 60 tax incentives that benefited individuals and small businesses just 2 weeks before they were set to expire. And that makes it tough for planning for a small business, for advertising, marketing. Included in the bill were a temporary extension of the Bush tax cuts, short-term estate tax reduction, a short-term extension of bonus depreciation, and modification to Section 179 expensing rules. A one-year extension of the alternative minimum tax patch, and a temporary extension of the residential energy tax credits described above. While extension of these tax incentives is greatly appreciated, the timing and nature of their extension make it very difficult for businesses to make business decisions. America's small business owners are worried about what may or may not happen next year. By sending the right signals to America's small businesses, Congress can eliminate the fear of the unknown, and I can assure you American small businesses will rise up and create new jobs. With that, I conclude my comments and will be happy to answer any questions, and thank you again for the opportunity to testify. I hope I didn't put you to sleep.
Not even close. Thank you, Mr. Morawski. Let's keep our Midwest bent going here. Mr. Carroll, you're from Ohio, right?
I'm actually originally from New York.
Oh, okay. All right. Close enough. Let's turn to Illinois. Our next witness is William R. Smith. Mr. Smith is President and CEO of Termax Corporation in Lake Zurich, Illinois, which I have the honor to represent. Termax is a small family manufacturing and engineering company specializing in metal and plastic fasteners. Mr. Smith is testifying on behalf as well of the Precision Metal Forming Association. Welcome, sir. You have 5 minutes. Thanks.
Thank you. Oops. Thank you. Chairman Walsh, Ranking Member Schrader, members of the committee, thanks for the opportunity to be here today. My name is William Smith. I am the President and CEO of Termax, based in Lake Zurich, Illinois. We're members of the Precision Metal Forming Association that has about 1,000 member companies representing $113 billion in precision metal products. That industry. About 2/3 of our member companies are structured as Subchapter S Corps or similar pass-throughs, as is Termax Corp. The industry averages about 50 employees per business, most of which are family-owned like ours. Now, my father founded the company in 1971, and in 1998, my brother and I took over the operations, where we've seen the company grow to about 250 employees, and we hold over 60 patents. Now, while primarily servicing the automotive industry, our company manufactures clips and fasteners for many industries, including appliances, lighting, toys, construction, automotive, and we're the #1 exporter of parts in the world for these sorts of things. Now, before taking over the family business in '98, I worked as a CPA, a certified public accountant, for roughly 20 years, also a small business, giving me a unique perspective to understand both the production and finance sides of manufacturing in America. In my experience as a CPA, the vast majority of manufacturers are structured as S corporations, LLCs, and partnerships, or other pass-through entities. Everybody has statistics. Our statistics showed that 50% of all private employers are structured this way. And among the PMA member companies, we know that 64% are also pass-through entities. We're structured this way because we're family-owned, with a limited number of shareholders and owners who are often our siblings and increasingly our children and grandchildren. It just makes sense. Manufacturers like us pay our income taxes at the individual rate. We claim deductions and credits at that personal level. This means that the financial and manufacturing success of our employees and businesses are directly tied to that of the business owners, the Smith family. The majority of manufacturers leave most of the money in the business, directly reinvesting in our employees, facilities, and equipment. And this is really the important point there. we're getting taxed on monies that we never see. It's just being held there. Now, due to our current U.S. tax code, we're taxed on income we don't take out of the company, but leave in the business to reinvest. This means we have fewer resources to put towards hiring, training, and buying new machines. In my experience, smaller manufacturers, based on wage and K-1 income, pay 30% or 36% in taxes. They distribute 18% to owners and reinvest 46% in the business. And that's conservative. We at Termax, we distribute 10% to the owners. The rest is either used for taxes or reinvestment. So the more money that goes into taxes, the less that's reinvested for our employees and machinery. These funds are taxed at the current 35% individual rate, set to increase to 39.6%. If statutory rates increase by nearly 5% as scheduled, business owners have to take it out of the pie somewhere, either from the owners' families or from the reinvestment in the employees and company, usually both. Tax increases result in reduced cash flow in the business, causing a major unintended ripple effect, limiting access to capital. Banking and other lending requirements have toughened, forcing most owners to leave retained earnings in the business for the sole purpose of meeting collateral requirements. The current system penalizes and taxes business owners who leave money in the business for reinvestment, resulting in reduced ability to secure loans. Therefore, increased tax liability means less money in the business, which will restrict the ability of a small business to access timely and sufficient credit to purchase machines, expand their facilities, hire new employees. This is particularly true for a pass-through entity like ours, who's taxed regardless of the actual distribution made to the owner. This is clearly a politically charged issue, but from the standpoint of the small business owner, we must do what we can to reduce our effective tax rate so we can increase our investment in new technologies and people to remain globally competitive. Over the last few years, Termax has seen our American competitors decrease to just 2 from approximately 8, while our foreign competitors have increased dramatically, 4 to 5 times what they were previously. This is where tax deductions credits come in, as the only tool we have to reduce our effective tax rate and give us an incentive to take action at that time. All manufacturing companies claim deductions and credits, from the R&D credits to bonus depreciation. Our company expects to spend $1.5 million in 2011 on R&D, just to develop new technologies for the automotive and construction industries. This is why removing deductions and credits such as the Section 199 deduction for all businesses will increase the effective tax rate and burden on all S corporations and pass-throughs. So some have asked why we S corporations simply do not convert to becoming a traditional C corporation. First, the costs associated with the conversion are astronomical, especially for a small business. Another reason is due to the family-owned structure of the business. When an owner passes a company down to the next generation, there's a much greater tax liability as a C corp. This is akin to the family farm being sold to pay taxes. If you ask them, most manufacturers want stability, simplification, and globally competitive effective rates. Prime example is the alternative minimum tax, the forerunner of the current millionaires tax that's being discussed. As a business owner, the most important questions are, what is my total federal, state, and tax liability? What's left over for me to invest and grow my business and create jobs? Thanks for the opportunity. Sorry it took a little long.
No, thank you very much. Our last witness is Stephen Kapp. Mr. Kapp's President and CEO of Laser Age Technology Corporation of Waukegan, Illinois, which I am also honored to represent. Laser Age specializes in custom laser services for diverse material applications. Mr. Kapp is testifying on behalf of the National Federation of Independent Business. Welcome, sir. You as well have 5 minutes to present your testimony.
Thank you. Good morning, Chairman Walsh, Ranking Member Schrader, and members of the subcommittee. My name is Steve Kapp. I am the President and CEO of Laser Age Technology Corporation. I am pleased to be here as a small business owner and member of the National Federation of Business, NFIB, the nation's leading small business advocacy organization, to discuss the impact of federal income taxation on Laser Age. My father and I started Laser Age in 1979. Now we're based in Waukegan, Illinois. When we started Laser Age, we were a tiny contract manufacturer with one laser. Over 32 years, we've added 135 employees and 65 lasers. We specialize in laser processing and materials for the medical device industry, but we also work with the electronics, LED, aerospace, and other industries. Currently, we export about 50% of the product that we manufacture. Like many small business owners, taxes are a major concern for us. In fact, 4 of the top 10 issues in the latest NFIB Problems and Priorities survey are tax issues, particularly tax rates and complexity. Small business owners are encouraged that Congress is considering tax reform, but reform must recognize the issues impacting small businesses and pass-throughs. First, I want to discuss why a business like mine chose a pass-through entity. An owner chooses a pass-through or business structure for a variety of reasons, generally because of liability protection or tax efficiency. LaserAge is a pass-through business, an S corporation. Not unlike a lot of closely owned businesses, we were originally organized as a C Corp. Ending the double taxation of our profits and gains as a C Corp was our primary reason for converting into an S Corp. Simply put, double taxation of our shareholders' profits, gains made their investment in our company less attractive. Frequently, business sales of closely held businesses are structured as asset sales, unlike sales of public companies, which are usually stock sales. As a C Corp, an asset sale would first be taxed at the corporate level, and then a second time when the after-tax proceeds are distributed to the shareholders. As an S Corp, in an asset sale, the sale only faces one layer of taxation at the shareholder level. Obviously, this single layer of tax makes the investment in our company more attractive. While the conversion adds complexity, this was a good decision for our company, and we urge that the S Corporation pass-through structure continue to be supported by Congress. Second, as a pass-through business, individual tax rates are especially important. As an S Corporation, we pay tax on our business income at the individual level. Keeping these rates low is important to keeping my company competitive. Over the last few years, my company's operating costs have increased steadily. My company has been getting strong pressure from some of our largest customers to begin production in a low-cost country. To this point, we have successfully resisted taking that action by remaining price competitive without resorting to leaving the United States, primarily by adopting what is known as lean manufacturing techniques and improving the efficiency of our production methods. But there are limits to what productivity enhancements can accomplish, and we anticipate that at some point we will have to establish some offshore production capacity or lose very significant customers. If federal tax rates increase, that will simply add to the pressure on us to move some of our manufacturing offshore. For this reason, mindful that all of the current individual income tax rates set to expire at the end of this year, I encourage Congress to keep tax rates low for all small business owners. Third, tax reform must recognize the issue impacting pass-throughs in small businesses. Much of the debate surrounding tax reform is focused on eliminating deductions and closing loopholes to reduce taxes. If that is the path for tax reform, Congress should keep some basic principles in mind pertaining to, first, tax rate, second, encouraging capital investment, and third, reducing complexity and compliance costs. First, rates must be kept similar to pass-throughs and C Corps. The current tax rate for pass-throughs are similar to C Corps. If the rates were to go down for C Corps but remain unchanged or go up for my S Corp, it would put LaserAge at a distinct disadvantage. Second, tax policy do affect capital investments. Let me explain. As a manufacturer, I operate a capital-intensive business. Last year, we purchased $1.1 million in capital equipment, and this year we will purchase another $850,000 of equipment. We were able to use accelerated depreciation for these costs, and it absolutely influenced our capital investment program. We simply could not have afforded these level of capital investments without these benefits. In addition, as a manufacturer, we rely on Section 199 domestic production deductions. Losing these deductions and credits without corresponding relief will also place our company at a disadvantage. Finally, one simple step that Congress can take is to simplify the tax code and make permanent expiring provisions. Last year, LaserAge's income tax return, technically an information return, was 416 pages long. Apart from costing an enormous amount of internal accounting personnel time and efforts, LaserAge was forced to pay an outside auditing firm $9,100 in professional fees to prepare the tax filing. My own return which includes my share of LaserAid's S Corporation taxable income, was 28 pages and cost me $2,500 to prepare. We should not have to spend so much time and incur so much expense for tax compliance. It isn't good for us, it isn't good for the economy, and it isn't good for Uncle Sam. In conclusion, tax reform can be an effective tool for economic growth, but must include small business and pass-throughs. The majority of private sector employees, 54%, work for pass-through businesses. Small businesses in particular account for a vast majority of new jobs. The Congress has the opportunity to reform our complicated tax code, but you must make sure to do it right. Tax reform must add the concerns of both pass-throughs and corporate businesses. Thank you for this opportunity to appear before this committee on these important issues, and I look forward to any questions. Thank you.
Thank you. Thank you, Mr. Kapp, and thanks to all of the witnesses for your testimony. Let me begin our questioning with sort of a broad issue that each of you touched upon, and I'd like it if you could give me sort of your broad overview. Generally speaking, would a system with lower marginal rates and a much broader tax base be preferable to pass-through entities than what we have now with a code with its numerous rates and deductions? Generally speaking, would that sort of move be preferable? Let's start with Mr. Carroll and work our way down.
Yeah, generally, that approach, a lower rates, a broader base, follows in the tradition of the 1986 Tax Reform Act. Economists will tell you that the welfare loss or efficiency cost of the tax system is related to the square of the tax rate as opposed to just the tax rate. So high marginal rates are particularly harmful from an economic perspective. So that's, I think, an important consideration. Lower tax rates are usually beneficial from an economic perspective. In the area of flow-throughs, high tax rates, high individual tax rates have been found to adversely affect investment decisions, hiring decisions, and the growth of small businesses. So that's clearly a consideration. In evaluating a broad tax reform, I think one needs to really look at the effects of the broad reform on job creation and economic growth, and where low tax rates will, I think, be generally conducive to that goal.
Mr. Morawski, in general, a move toward lower marginal rates, a broader base, and in general getting rid of a lot of these deductions. Is that preferable?
Oh, I would say most definitely. You know, by basically sharing the wealth and spreading it over and reducing the rates, you're going to put more capital back into the market. You're going to have more investment. You're going to have much more activity, and you will see a definite growth. I don't know all the numbers like Ernst & Young off the top of my head, but they're anything you can do to reduce the rate and then spread the tax base around is going to be nothing but positive on our whole economy.
Mr. Smith.
I think it depends. A company that's highly capital intensive, such as our two companies, are going to have, if you take away the deductions that relate specifically to capital investment, machinery, that sort of thing, those are going to have a very negative effect on companies, or a bigger effect on a manufacturing company than they would on a restaurant or a service industry. So I think it needs careful consideration on both sides.
Mr. Kapp.
I agree with Mr. Smith. You have to be careful what you do. Obviously, I think overall it's a good thing, but those tax deductions and credits, there's a purpose for giving incentives to, especially in capital-intensive businesses like ours, to invest and reinvest in our company and create more jobs. So, you know, within reason, I think, as long as they're carefully considered, I think the answer to that's yeah.
Last quick question from me, and how about a brief answer from each of you? Tax reform is being bantied about up here, as we all know, and probably will continue to be. If you were in front of the super committee right now, and you could weigh in when it comes to this issue, tax reform and specifically how it impacts pass-through entities, what's one word of caution or one word of advocacy? What would you advocate for if you had a moment or two in front of the super committee? Let's start with Mr. Kapp and then quickly work our way down.
I would say lower taxes and also certainty. There's a lot of things that we aren't doing because we're not sure what the tax code is going to be. I mean, just lower taxes and put some certainty in it so we know what we have to do and where we have to go.
Mr. Smith.
Well, as I stated in my testimony, I agree with Mr. Kapp here. The problem we have is uncertainty. We would like for years and years of consistency. We can compete with anybody in the world if we know where things are going to be. But because of the state of flux that our tax code has been in for years, it creates a very big disincentives for companies like ours.
As I said in my testimony, also is the same thing as the uncertainty, not being able to plan, not knowing what's going to happen. You're doing one thing one year, one thing the next year. Frankly, I'm a national sales tax. My personal opinion is, it's fair and it's even, and it allows the capital to stay within the companies.
Mr. Carroll, conclude. What's one specific tax reform you might advocate for when it comes to these pass-through entities?
I think I would have some difficulty advocating a specific reform. I would think that one would want to take a very broad view, and in addition to the certainty, also a stable tax system that won't change that's going to provide some certainty over a period of time. One of the things that did happen in the '86 Act is the tax system changed fairly quickly several years after the '86 Act. It, in a sense, unraveled, and in some important respects, the tax base, even though the '86 Tax Reform Act lowered rates and broadened the base, the tax base was narrowed and tax rates went back up. The other thing I would think that they should carefully consider is trying to avoid unintended consequences. There are a lot of interrelationships in the tax system as well as the economy, and trying to avoid unintended consequences, and I think that would be a very useful objective.
Thank you. Let me now turn to my California colleague, Congresswoman Chu.
Thank you, Mr. Chair. Mr. Carroll, I'm interested in your opinion as an economist. If we do tax reform, we want to make sure that we do it right so that it is effective, helps the U.S. economy, and will create jobs. And there was new data from the U.S. Department of Treasury that shows that the ownership of these larger pass-throughs, in particular subchapter S corporations, is highly concentrated amongst wealthy taxpayers. If we're trying to help small businesses, is a high-end rate tax cut the best strategy? And how can we ensure that we are hitting the right set of small business owners that really need the tax relief?
I think one needs to take a very broad view on tax reform and really consider the interrelationships. One of the problems, I think, that exists in our current tax code is the double tax on corporate profits, and the idea that the corporate tax is basically a second layer of tax on equity finance investment that distorts a number of very important economic decisions. And it raises the cost of capital on investment generally. It leads to the misallocation of capital by creating a wedge between investment in the corporate and the non-corporate sector. It accentuates or increase. It leads to a tax bias for debt finance, resulting in greater leverage of firms, which is problematic in periods of, particularly problematic in periods of economic distress, economic weakness. Companies that are more highly leveraged may have more difficulty. So I think the double tax is a very, very significant issue. And so if one's looking for, I think it's very important to, when one's thinking about the pass-through sector and flow-throughs, that's a vehicle, a way in which businesses are able to avoid the adverse effects of the double tax, and it's very, very helpful to the economy. So rather than trying to push more firms into the double tax. I think one needs to kind of look at it the other way and think about how relief from the double tax can be expanded. Most other developed nations have explicitly provided relief from the double tax by either providing relief at the shareholder level or at the company level. In the U.S., it's only recently, since the beginning of the last decade in 2003, through the lower rates on dividends and gains, that we've provided some relief. But even with that relief, we're still at the high end of the overall tax on corporate income dividends and capital gains combined with the corporate level tax.
But I guess my question really is would it be beneficial equally to all strata of business owners?
Again, I think one needs to really think about what's going to be most conducive to job creation, economic growth, and I think the more equal treatment between the two sectors would probably be very helpful.
The report also mentions that some pass-throughs are passive holding companies in which there are no entrepreneurial activity. These companies don't hire any employees. And many are sole proprietors and independent contractors. But on the other hand, there are pass-throughs like the small businesses that have testified here today that are indeed doing entrepreneurial work and hiring people. So how could we refine the tax strategy so that we really emphasize the job creators?
Yeah, I guess I would go back again to the double tax. I really see the double tax as a significant problem, the high corporate tax rate. And trying to address that issue rather than trying to expand the scope of the double tax by perhaps subjecting more. A lot of the debate is really focused, this part of the debate is focused on where do you draw the line between the corporate sector and the non-corporate sector. And I think because of the harmful effects of the double tax, the way in which it raises the cost of capital, increases the bias for debt finance, drives a wedge between the two sectors, redrawing the line so more economic activity is subject to the double tax, I think is problematic.
Let me ask about the Joint Committee on Taxation analysis, which showed that the proposal to reduce the corporate tax rate to 25% could require some pretty hefty repeals of the tax expenditures that encourage job creation. How would the repeal of some of these job creation tax expenditures impact small businesses?
Well, I think weighing the benefits of corporate rate reduction base broadening, one has to be very careful. I agree with the sentiments of Mr. Smith and Mr. Kapp in terms of talking about some of the capital-intensive provisions. I think one has to go through each tax expenditure, each special tax provision, and really think about and weigh the positive benefits that those provisions provide to the economy. Provisions like accelerated depreciation, like the R&D credit, many other provisions. All of these provisions were put into the code by the Congress with good intentions, with the notion that they were providing some economic benefit to the tax code. And there are significant economic benefits from a lower corporate tax rate, but I think one has to weigh that very carefully.
In fact, Mr. Murawski, you talked about the fact that you have, of course, a lot of equipment in your air conditioning business, and how important certain tax cuts are to your business. Which tax credits would be most critical to your business and other small businesses like yours?
We're not nearly as capital intensive as Mr. Kapp or Mr. Smith's company. We don't have large investments in machinery. Ours is mostly vehicles. For us, like there used to be the investment tax credit, which was a great thing for purchasing vehicles and machinery. If I remember, it was a 10% credit on the purchase of equipment. That was back in the 70s and 80s. In our industry, incentives on training and human resource issues would be a tremendous advantage because we're very labor intensive in the service industry. We have basically no or minimal capital investment.
Okay, thank you. I yield back.
Thank you. Let me now turn to a fellow Illinoisan, Congressman Bobby Schilling.
Thank you, Chairman. Mr. Cap, I also started out my small company with a C corporation, and for the exact same reasons, changed over to an S corp. But you know, coming from Illinois, we just took the largest tax increase, individual tax increase, state taxes in the history of the state. Corporate tax rates also went up, you know, and I find it very interesting that some folks around believe that higher taxes are going to actually help unemployment and then also help the revenue funds of states or the country per se. But in Illinois, for example, since the largest tax increase of the history of the state happened, we've already lost over 89,000 jobs in Illinois. So, you know, the thing that's nice about being small business folks is that we get it. And with us starting up our business, one of the fears that I have is that a lot of the small businesses, including myself, had I not been able to put that money back in to my business and invest into it, I don't know if I would have made it. And my fear is that as we continue to want to tax the job creators, you know, it's going to be a problem for the guy that's sitting in his garage trying to figure out how to get this thing off the ground. You know, and what are we doing to our Steve Jobs guys? I mean, look at Apple Computer. I mean, it's just amazing the process. And one of the things that's very scary to me, I'm fresh in. I came straight from the restaurant business to Washington, D.C. And a lot of times in Washington, we tend not to look at the unintended consequences. In business, we're forced to look at, if I'm going to, you know, make an investment into my business, I look at 10 years as to how this is going to either adversely or you know, how it's going to affect our business. So I think that that's something that's very, very important. And I think when we do any type of tax reforms, we do have to be careful because we see a difference here between the two businesses. You know, he's buying vehicles and you're buying a lot of equipment for inside. So I think that it's one of those where you come in with a scalpel. You be very careful on how you do. I mean, because the write-off of the equipment is pretty imperative. But at the same time, I think that the key thing that I'm hearing here is basically you know, give us a little leeway here, you know, and I think it's great, and I give all of you credit for coming here today because I think that if we were to listen to the small businesses a little bit more, as I call them, the final 3 feet, the people that are actually putting people to work. But sorry for the rant. But what I wanted to do is just, Mr. Cap, when you talked about the 01 tax breaks, can you tell me a little bit more specifically on how that affected your business?
Specifically on the 01 tax breaks?
Yeah. Like what was different from prior to 01, how it helped you, or?
I think, you know, it allowed us to take a look at equipment and other things and really, you know, gave us more incentive to push, you know, equipment back or money back into the business to grow the business and buy the equipment that we needed to create the jobs was the primary thing.
Okay. You know, I guess this is kind of a pretty simple question. I think I already know the answer. And I'm going to just kind of roll right down the line here. Do you believe that more regulation from the federal government and higher taxes is going to help you create more jobs?
The answer to that is absolutely not. We have so many people in our company now that are, at least part of their job is dealing with regulation, and it seems to be getting more and more and more. And when I got people that I'm paying to deal with regulation, they're not doing productive things, making the business grow, focusing on customers, things like that. So the answer to that, absolutely.
Well, obviously, I mean it's a no-brainer answer. But we've ended up hiring an OSHA compliance staff person just to make sure that we are in compliance with OSHA. Now that's outside of the scope of this process. But obviously, it hurts. If you think about it, tax accountants are really just the whole tax code is a full employment act for accountants.
That individual that you hired, what is the cost to your company on that, sir?
About $60,000 a year.
$60,000, but we created a job. Is that correct?
That's right.
your question kind of is, hi, I'm from the government, I'm here to help you. Yeah, it would definitely, we would not be in favor, nor anyone in our industry.
Yeah, the only thing I think I would comment on is one could think of a lot of the regulations as, in effect, are imposing in some form additional taxes, additional expenses, additional time spent by entrepreneurs on complying with those regulations. So that's kind of a way of thinking about holistically the regulatory and tax environment as they're two sides of a similar coin.
Yeah, very good. Thank you for your time, Chairman.
Thank you, Mr. Schilling. Let me now turn to Congressman Hanna from New York.
Thank you, Chairman. Mr. Morawski, do you you mentioned tax credits to homeowners to help them, incentivize them to. Do you think that to improve the insulation of their homes or upgrade their heating systems or air conditioning, do you think that drives the decision to its ultimate conclusion?
Most definitely. Most definitely. You'll see in your state, you have some great utility incentives for people to, we call it home performance. Insulate, windows, duct system, ceiling, many different things. And you've got some huge incentives via your utilities in New York State. But New York State probably is doing the best of any of our 50 states in that. My state of Michigan, it's a mishmash and a mess.
Do any of you gentlemen, Mr. Kapp, Mr. Smith, Mr. Morawski, know, Mr. Carroll may know in a broader way, what's your effective rate? I mean, we all know what the actual rate that you pay or that's listed on your in the tax code, but do anybody have an idea what your effective rate is after all the depreciation, tax credits, accelerated depreciation, et cetera?
I don't think you can hold me to this, but the last time I calculated, it was about 27, 28%.
For us, actually, the PMA, our association has created quite a comprehensive tax template for those things. I don't know if you've had a chance to review it, or if you've seen this. Our particular company, including local and state taxes, is 35% right now. So that's what affects me and our company.
But that isn't your the actual rate that you pay after all the.
No, but again, that's with after our base case where we are right now is it turns out to be 35% of the total dollars that are going into that. The actual federal taxes are approximately 27.7%.
Okay, so.
Right.
Morawski, you have any idea?
You know, I don't know. I'd be taking a stab in the dark.
Mr. Carroll, what do you think it is for all the people you handle?
Well, I don't prepare tax returns. I'm an economist, and I tend to work on tax policy issues. So I have the virtue, or I suppose, of not working on actual tax returns. I guess I would observe there are really different ways of thinking about tax rates. One could think of an average tax rate. One could think of an effective tax rate. One could think of a marginal effective tax rate that would take into account different features of the tax code in different ways. A favorite concept that's often used by economists to think about investment decisions, allocation of investment, the amount of investment in the economy is the marginal effective tax rate that would take into account not only the top line individual or corporate tax rate, but also take into account the value of accelerated depreciation and investor-level taxes on capital gains to indicate the variance of tax rates across different types of economic activities.
Do you think that advantages given to capital investment for equipment, for example, with Mr. Smith, or do you think that they're pitted against someone who is less capital intensive than, say, Mr. Morawski's business, which is mostly labor?
Yeah, I think there can be a fair amount of unevenness of tax rates across at different economic activities, at different industries, different sectors, companies that invest in particular assets versus others. There's a fair amount of unevenness, and that's certainly a consideration.
So does that suggest to you that Mr. Morawski might be paying a disproportionate share based on the total volume of dollars he does compared with?
Yeah, I think one has to come back to, again, the value of the specific tax preferences. If one, for example, were to think that a provision like the R&D credit provided some significant spillover effects to the broader economy, or one thought that incentives for some of the renewables, alternative fuels, solar, geothermal, and so on was providing spillover effects to the overall economy, then one might be able to justify the unevenness. I think it was a couple of years ago, the Congress had considered requiring the Joint Committee on Taxation to do a cost-benefit analysis of each of the tax expenditures in the Internal Revenue Code, with the notion of evaluating on a cost-benefit basis whether those provisions were providing sufficient value to the economy to justify their presence in the code.
But then, my time is up. Thank you, Chairman. You said that, Ms. Kapp, that you were encouraged to invest in capital equipment because of the accelerated depreciation. Do you think? I mean, do you think that it's you wouldn't have done it otherwise? Is that I mean, is that what I can infer from that?
I think it's more a question of timing when we would have done it. With the uncertainty of what the next year's tax code was going to be, we accelerated purchasing equipment that we probably would have pushed out and bought in a more timely manner for us.
Thank you, Chairman.
Thank you, Mr. Hanna. Let me now turn to Congressman Chabot from Ohio.
Thank you, Mr. Chairman. I apologize for being a little bit late, and if my questions have already been asked, I also apologize for that. I've got 3 different hearings going on at the same time, and I'm trying to bounce around and make all of them.
That's no excuse.
I know it. Sorry, Joe. But in any event, and mine are going to be kind of broad. When I first came up here back in the Revolution, back in '94, Newt Gingrich's contract with America, all that, there was some real serious talk about really reforming it. And we're talking about that now, and we got this super committee, and are they going to go long, or what's going to happen? But there were 2 competing philosophies. You basically had the Dick Armey philosophy, which was the flat tax, and you can basically do your taxes on a postcard and send it in, although nowadays, we don't do anything through the mail, so we'd probably email it in or something on something even smaller. But that was sort of one philosophy. And then you had Billy Tozen and Bill Archer, who was the chairman of the Ways and Means Committee at the time, who wanted to go for a consumption tax or a sales tax and get rid of the IRS altogether and get rid of income taxes altogether. And then we now have, maybe a hybrid plan that one of the Republican presidential candidates has put forward, the infamous or wonderful, or whatever you think about it, the 999 plan. And there are various versions. But I'd just like to see, and perhaps, Mr. Carroll, we could make this, I mean, you're with a very large and prestigious accounting firm, and if we went to one of those other things, it would probably make it less likely that folks like those folks over there and a lot of other folks might need accountants and attorneys and things to figure all this stuff out. Maybe not, but at least in theory. So I'd just like to throw it open for anybody who wants to take this on, and I've got about 3 minutes, so if you each want to take, a little less than a minute and just go down the line, maybe we'll start with Mr. Kapp down there.
I'm not entirely clear what you're looking for here, but
which is basically what you think. Would you prefer to have a flat tax? Would you prefer to have a national consumption or sales tax? Would you prefer a hybrid where we have both low right now, but could potentially be jacked up down the road somewhere? Or do you think we ought to keep the stupid mess we have right now?
I guess I tend to lean more towards a flatter tax. I know that there's a lot of other ones out there like sales tax and things like that. I think they have to be weighed very carefully. And when it comes to us as small business people, is to seeing to it that it doesn't disrupt the job creation at the small business level. So it could be really any one of those, depending on exactly how it's approached and how it's actually executed.
Okay. Mr. Smith?
In all honesty, I don't care. What I care about is just consistency. And I don't think it's going to matter on a long-run basis for a business like ours in any way. Of any approach that is taken, I would like a 10-year or 20-year or a moratorium on change for a period of time. That's really all I care about.
Okay, thank you. Mr. Morawski?
You know, any one of them, as Mr. Kapp mentioned, needs consideration, and whatever you do needs to be, again, consistent, and it needs to be fair. My gut reaction, as I mentioned a little earlier, is I like the national sales tax or consumption tax. If you have more money, earn more money, you're going to spend more money, and you're going to pay a higher level of tax. But there's other, you know, drawbacks in that. People that are at minimum wage levels, you know, maybe you've got to come up with something like that. So it needs some thought and some thinking, but it needs to be consistent, fair, and long term.
Thank you. Mr. Carroll, if you want to clean up.
Yeah. A couple of thoughts on the choices: the flat tax, the sales tax, a potential hybrid. You know, one thing I would say is I agree with the sentiments that a tax system that's predictable, provides some certainty, and that's stable would be particularly helpful. We currently have a tax code where about 25% of the income tax will sunset at the end of 2012. So that creates a lot of uncertainty for people, such as those who are sitting at the table with me. That makes it difficult, I think, to make business decisions and other decisions. Another comment I would make is the flat tax and the sales tax are really very, very related. They're at least first cousins, if not second cousins. One of the characteristics that both of those taxes share is fundamentally they don't tax the return to savings and investment. They're types of either both the sales tax and the flat tax are both types of consumption taxes. And then I would go on to say that our current tax system is really a hybrid of some of these. We have features in our current tax code that make our tax code a bit more like a consumption tax through accelerated depreciation, through other expensing provisions, through 401ks, IRAs, defined benefit plans on the household side. Those provisions all reduce the tax on the return to savings and investment, and the idea behind a consumption tax, one of the reasons a lot of economists like consumption taxes, and is that by not taxing or taxing less the return to savings investment, they're conducive to economic growth. But you do need to balance those systems from a distributional perspective. When you don't tax the return to savings and investment, where savings and investment is received primarily or disproportionately by higher income households, one needs to think about the distributional consequences of going in that direction. So those are a few observations I think are worth.
Thank you very much, Mr. Chairman. I've been informed I have yet a fourth meeting out in the hallway, so I'll have to take off. Thank you very much. Yield back.
Thank you. Let me turn to Congressman Mulvaney. He's all good. Okay. Let me close and just revisit one quick question, and I'm going to ask you each for a yes or no answer. How's that sound? Understand that under the President's jobs plan, taxes on capital gains are going to increase. And if we let the 01 and 03 tax rates expire, that will increase your taxes. Will tax increases like those help you purchase more equipment, create jobs, and will it grow the economy? Yes or no?
No.
No.
That was difficult to just...
No.
I guess I would have to say
Mr.
no.
Carroll? Thank you. And thank you all for participating today. The subcommittee will continue to closely follow these issues related to tax reform. Following the hearing, we'll be sending a letter to the Joint Select Committee on Deficit Reduction, which will have a critical role in determining this tax policy and reducing the deficit. And we will relay the concerns that have been expressed by the witnesses today. I also ask unanimous consent that the comments of several small business owners regarding the importance of individual tax reform, which were submitted through the committee's website, Open Mic, be admitted to the record. Without objection, so ordered. Finally, I ask unanimous consent that members have 5 legislative days to submit statements and supporting materials for the record. Without objection, so ordered. Where's my gavel? Let me now bang this, and without objection, the hearing is now adjourned. Thank you very much.